What's going on, traders? This is Jack with the Trading Tribe. Excited to be back at it today for a little trading lesson. We're going to really look at and try to understand today how to find what we call demand levels when trading. And I think this is a really important tip to just understand how trend traders at least look at the markets and when direction is clear, how we can essentially find those demand zones to risk off of. So hopefully it's valuable for everybody. Feel free to like and subscribe to the channel for more of this. We have a ton of content coming out in this next 12 months. So excited for more valuable material as well. So let's get into it. And today we're going to look at natural gas. It actually presented a really clean uptrend today. So it's a perfect example of how to spot demand zones and kind of what they actually present on the chart typically. And in trading, there's really kind of two different types of trends, right? So if the market's direction is clear and the market is trending, right, there can either be an uptrend in the market where the market's making higher highs and higher lows, similar to this one, right? Every time it goes low and goes high, it makes a new high and a new low, right? New high, new low. And it really has done that periodically all day, right? I guess it made a little bit of a lower low here, but at the end of the day, right, it came down to VWAP, held, made a higher high. Now, for example, it's kind of struggling to make a high, but it is making a higher low. So this is really a clear sign of an uptrend, right? Think of it kind of as a wave in the ocean, right? It's making kind of a sequential wave of higher highs and higher lows. Vice versa, right? If we were looking at a downtrend, it would be making lower highs and lower lows. So today we're really going to be thinking about when there is an uptrend, right? As traders, how do we find a safe area to get in and a safe area to risk off of? And that's what we like to call a demand zone. So if we take this chart, for example, we can see that ever since really about midnight, right, futures markets pretty much open all day. So we'll notice the price really based out right around this 6 level and essentially started making higher highs and higher lows. And when we're thinking about a demand level, that's essentially where there's going to be a lot of buyers. So if we're thinking about just the price chart here, once it actually breaks VWAP, we'll notice it breaks this high right here. So if we drop a level there, and I'll get rid of this floor level, we'll notice, right, this ceiling right here gets broken and it actually becomes a floor. And it was held twice as a floor. And this is what we like to call a demand zone, because essentially when something was a ceiling in the markets and is broken and it's in an uptrend, typically that prior ceiling will become the new low. And sure enough, right, it came down, bounced, came down, bounced, and went on this massive rip and really did the same thing, right? Kind of made a ceiling, if you will, and broke out of that ceiling for another really big move, and then essentially came all the way back down to that demand zone where we expect buyers to be. So really, anytime these ceilings are broken for a big move, we expect when price comes back to respect that level as a floor. And we call this a demand zone because of that exactly, right? If we think about it, when it comes back to this level, we expect a lot of buyers because last time it was at that level, right, there were so many buyers that the price pretty much just went straight up. So it's essentially using the past to help us with what's going to happen in the future. And with demand zones, right, sometimes the price is too strong, right? So we'll notice, natural gas on this day was too strong to come back to that level really ever throughout the day. But it did make another level, right? So if we look at this, in this case, a little bit later in the day, right, it came up to this level right around 6.29 and started failing, and it was kind of a zone because there was a little bit of a wick poking out to about 6.306. But we'll notice, right, in this little pocket of highs, it kept failing kept failing, kept failing. And then at the end of the day, right, it actually broke out again. So this became a demand zone again and came back down. And we'll notice, right, based on timing, these were actually the trades that were available today for us. But basically, we would have traded off of this demand zone with a risk level ideally underneath the zone. And so essentially, this is how we've essentially structured a lot of our trades today. And you do have to be careful when the higher highs stop. So technically, this was the best trade so far in this current demand zone because it made that higher high, came back to our zone. And if you get in here with a stop loss somewhere underneath this zone, depending on your risk and your targets, right, are right about at this high, right, you know where to sell essentially as well. And that's what's really nice about these demand zones, right? When you find the demand zones, it gives you a really good place to get into the trade. It gives you a really good place to put a risk level against your trade. And then it also helps you with your target, right? Your target for the trade should be the last place it went. So if we got in at, let's just say 820 right here, our target is going to be right around that 6.41 level. And then our risk, right, would be whatever makes that trade a 2-to-1. So typically, if it's going to make us about $700 potentially, I'll be willing to risk at most about $350 for the trade. In this case, this trade could have made you $1,100. So really, really nice move. And that would essentially open you up to about $500 of risk if you were willing to give it a 2-to-1 ratio. For a trade like this, what's nice about the demand zones is they should hold. So you can have a little bit tighter of risk. On a trade like this, I would be comfortable with even about 30 ticks or $300 of a stop loss because you'll notice, right, that would still put your risk under this zone. And if anything, we don't expect it to break the zone. We'll notice buyers stepped in every single time it got to that zone. And then real time, right, buyers are stepping in again at that zone, which we expect. And the one thing here to be careful on with demand zones is we always want that higher high before we get in. So this is why I did not get in on this dip, right? It still did come down to our zone. So you can absolutely take this trade. It's just a little bit more risky because price has really been struggling to break this 6.4 area for quite a while, right? For the last couple hours, we've been failing at the same place, which for me at least doesn't trigger that entry. I want to see the price break, and initially that first retest back to the demand zone is my favorite trade, but I will take subsequent bounces as well, as long as there was a higher high. So we'll notice there was not a higher high ever since this, zone right here. And so that's why I have not taken any of these other dips. But the nice thing is, right, it gives you a really good place to get in a trade, gives you a really good place to get out of the trade, and hopefully this helps you structure those uptrend type days and helps you structure trades on how to exactly attack the markets when you're seeing this on your charts. This can be extrapolated everywhere, so even in the stock market, the same sort of pattern typically will play out on an uptrending day where you can essentially spot buyers and where the actual trend should go. So hopefully this helps everybody that watched. Thank you so much for tuning in, and we will be back in a few days with another lesson. Thanks, everybody.